Okay, so let's move along. We're going to change up, and we're not going to go over those analyst reports, and we're going to look right to the topic of the day, the financial 15 topic of the day, and that is going to be important QCD details you should know. So this is that. Typically the last 15 minutes or so of the broadcast of the weekly webinar, but I'm expanding it a bit today because it's a big topic, and I can't be here past 11. So I don't think it'll take that long, but I want to leave plenty of time. So if you're just joining us on this portion, because we do segment them out, we have the Tuesday weekly webinar, which is the entire length and details of the webinar, including the slot reports, including the market updates and the financial 15. But we separate those out, and we just have the section called the financial 15. And of course, we have the weekly webinar available for now on our YouTube channel. But if you're just joining us on YouTube and you haven't already, please hit the subscribe, like, and notification button so that you're sure never to miss a new webinar or Financial 15. So today is about qualified charitable distributions. And where does today's topic come from? Well, like most topics, it comes from a conversation someone had with me about qualified charitable distributions. And it also came from the exam that I had to take from the training event, the Ed Slack training event in April, where we covered QCDs quite a bit. And not only I shared with you, and if you're just joining us, I'll share with you this manual again. I'm fortunate enough to be part of Ed Slatt's Master Lead Advisor Group, and this is an example of the manual from one training event. We have 2 a year and ongoing access and resources to their great team. And every now and then, Ed even comes to town and meets with y'all. So, oh gosh, what was my point? Oh, but we have an exam that we have to take after this event. And there were some really good QCD or qualified charitable distribution topics on that exam. So I thought I'd share it with you. And I'm hearing more and more about it from clients and other, and prospective clients or people who just have questions. People are very interested in this QCD or qualified charitable distribution. So let's first talk about what it is, and then we're going to go over some details and little known details to the QCD rules and requirements. So the QCD was really designed to handle required minimum distributions from IRAs that someone doesn't necessarily want or need during their lifetime. So we all know now that under the Secure 2.0 Act at age 73, the year you turn age 73, and for the first year, you have until April 1st of the year following the year you turn 73 to take a required minimum distribution. And the IRS tells us exactly how much that required minimum distribution is supposed to be. And there are very complex requirements about where the money should come from and what needs to be distributed, but it can be quite a bit. And many people say, and you have to pay tax on those distributions. So if you're fortunate enough to have $1 million in your IRAs or 401k, then your first year's RMD will be just about $30,700 today. So that might be great. And you might say, hey, that's great. I want that money and I'm going to spend that money. Or you might say, well, I'm going to have to, I really don't want that money. I don't need it today. I'm living off of some other money or whatever the situation is. But the issue is that you have to take it and you have to pay tax. And if you're 63 today and obviously, hopefully you're going to be 73 in 10 years, the problem is that we don't know what tax rates are going to be in 10 years. So you're subject to the I don't know tax rate. But, we do a lot of study around this, and our feelings are that your average middle-class American is going to be in the 40 to 45% effective tax rate by around 2030. And that's much, much higher than it is today. So many people are looking for ways to say, okay, I want to plan for a way to help reduce or eliminate this required minimum distribution. And one of the things that that is allowed now is a qualified charitable distribution. So, geez Louise, charitable, I wrote contributions. That is distributions. What's wrong with me? So I'm glad I saw that. This allows for a distribution from your IRA to go direct to a charity. So allows charitable contributions up to $100,000 per individual. This gets increased with Secure 2.0. We're going to see that, and this gets adjusted for inflation, but not until 2024 does that begin. But allows charitable contribution up to $100,000 per individual. So if you wanted to, if it fit in your plan, folks, you've got to make sure you're not going to need this money before you start sending money away from funds that you can spend. So the first step is develop your financial plan. Identify that, hey, this is going to be extra money that I don't need during my lifetime. I don't want to pay unnecessary tax on it. Now, what can I do with it? People sometimes get caught up in complex and sophisticated financial planning and tax planning, and they want to get in on it, right? They want to get on Roth conversions. They want to get in on qualified charitable distributions and things like that. But what sometimes they miss is a lot of people over Roth convert their money, and some people, I'm sure, will be sending money to charities that they really should have kept and had available for spending for those. So the first step is make sure this fits in your plan. So let's put this in here. So number one, make sure this fits in plan. Got to have a financial plan, folks. And for my seasoned veterans here, type in the chat box there, how often should these plans be reviewed? Let's help teach our new people that are just joining us. But all right, so allows charitable contributions up to $100,000 per individual, but it must be direct to the qualified charity. So it can't come to you first. You can't distribute $100,000 from your IRA, put it in your bank account, find your charity, and write a check. That's not how it works. If you handle it that way, you may be able to deduct it as a charitable contribution, but you're certainly going to have to pay tax on that distribution that comes out. And it doesn't have to be $100,000. Remember, it can be up to $100,000 per individual. So if you're a married couple, under the rules, you could do $200,000 today. All right. People are saying, yes, every year your plan should be reviewed every year. Thank you, Doug and David. The third item here is it must be done after the donor passes age 70 and a half. Now, I know I told you earlier is age 73 for RMDs. These were set up for RMDs. These were set up before the first change of RMD age from 70 and a half to 72, but the IRS never changed this. Congress never changed the allowance of qualified charitable distributions at 70 and a half. And there's been at least one iteration of the Secure 2.0 and other regulation clarifications, and they've left this alone. So beginning at age 70 and a half, you can begin doing these qualified charitable distributions. So again, if it's part of your plan and you want to start distributing money from your IRAs and not pay tax on that money, right? Because what happens is you distribute it direct to the charity. You don't pay tax on it. That's the other than the charitable reasons for it, that's the reason for it from a tax planning view. But you must wait until you cross that 70 and a half birthday. Listen, when my kids were young, and we still should be doing it now, but we always celebrated half birthdays because I said to my wife early on, I said, you only get so many of these, right? 18. And then they're off to college, and who knows how often you're going to see them. One of my oldest daughter is going to be moving to Hawaii soon, and then from there someplace else. So I don't know when we're going to see them. So we went through and celebrated these half birthdays. Well, folks, you might want to start that again because you've got some triggering events. 59 and a half is when you could start pulling money out of your IRAs. 70 and a half is when you can start qualified charitable distributions if it fits in your plan. So it might be fun to start celebrating half birthdays. We never get enough of them. So, but it must be done. If you do a qualified charitable distribution in the year you turn 70 and a half, and your 70 and a half birthday is not till June 6th, 2023, but you made the charitable contribution on June 5th, 2023, it's not going to count. You've got to cross that bridge. You've got to be past 70 and a half. I don't know how to accent that more. You have to follow the same substantiation rules for charitable itemized deductions that you would for a normal charitable deductions. They apply to a qualified charitable distribution. So we're going to talk more in detail about that. And documentation is required. And we're going to talk about these two things in more depth in just a moment. So there are the basics. It's based off of required minimum distributions. That's how it came about. It allows you to empty money out of your IRAs up to $100,000 per individual without paying tax. You have to identify a qualified charity. It has to be a qualified charity. You send the money directly to the charity. You can't take a check, take a distribution from your IRA, and then send that check to the charity. It's got to come directly from the IRA custodian to the charity. Must be done after you turn age 70 and a half. So not in the year that you turn 70 and a half, but you've got to cross that bridge. So start celebrating those half birthdays. If the validity of the qualified charitable distribution follows the same substantiation rules for charitable itemized deductions for the QCD to be allowable, and documentation is required. So here's what we're going to do. I showed you the book. So this section here comes right out of this book. So I've got several pages. I'm going to go through them as quickly, but as thoroughly as possible. So I explained to you there are two ways, as part of what we reviewed, two ways that Secure 2.0. So unfortunately, I don't know the date, but I think it was February or March. It must have been a little earlier than that. I think it was February of this year. So early 2023, we got this new regulation we refer to as Secure 2.0. So it's the update to the Secure Act. So one of the things that it did is it made some expansions to the qualified charitable distributions. It did a lot, but one of the things is it expanded the QCDs, the qualified charitable distributions. And I may have just said deductions. Whatever I say, contributions or deductions, what I mean is qualified charitable distributions. It is a distribution from your IRA. All right, so it reads here, and I'm not going to read every page to you. The IRA owners, I'm right here, IRA owners who are age 70 and a half and older can transfer up to $100,000 annually tax-free from their IRA to a charity by doing a qualified charitable distribution. Secure 2.0 expands QCDs in two ways. Number one, right here, Secure 2.0 indexes the QCD limit of $100,000 limit for inflation. And that, again, that begins in 2024. So it's not just stuck at $100,000. It's going to adjust every year, given a formula. Now, I haven't seen the formula. I haven't looked it up. It probably isn't a direct formula like consumer price index. It's probably a little more complicated than that if we're following government guidelines, because everything else is a little more complicated. But we'll see how that works. And then there's also Secure 2.0 allows certain split interest entities to receive QCDs. So we're going to talk a little bit about the split entities. So we talked about the fact that the inflation is subject, the inflation increase is increased starting 2024. And this is an important note. So QCDs remain available only to IRA owners. The Secure 2.0 did not expand QCDs to employer plans. So 401ks, 403bs, 457b plans, other simple IRAs. Well, yeah, I don't think simple IRAs apply, but not employer plans. So this is an area, right? So you've always got to pay attention to the details, and you always hear me say there are critical items or critical elements that can make significant differences, because you might take distributions from your 401k and sending it to a charity and think you're doing a QCD, but you can do that for several years and you're doing it wrong. And that money all has to come back to you when you have to pay tax and penalties. So you got to be really careful. So IRAs only, not employer plans. So what are split interests? Let me just read this to you. Prior to the enactment of Secure 2.0, QCDs could only be made to charities. They were not allowed to be made to split interest entities. Split interest entities allow the donor to receive a benefit during his or her lifetime or for a set term, with the remainder benefiting a charity after the donor's death. And we're going to talk about what they are. They're certain type of trusts and allowable donations. Secure 2.0 changes this rule by allowing a one-time only $50,000 to go to certain split interests entities. One time only and up to $50,000. You'll see another question about that later, but these qualifying split entities include charitable remainder trusts, or referred to as CRATs. And here's the IRS code. If you want to pause this section, you can look up that IRS code. A charitable remainder unitrust, or a CRUT. And I'm not going to go into the details of what's a CRAT and a CRUT and all the different trusts. As defined by, here's the IRS code on that. A charitable gift annuity, again, the IRS code on that. This does require that the annuity must start fixed payments of 5% or greater no later than 1 year from the date of funding, if it's a charitable gift annuity. So that's an example where that's really what the split interest entity. So you get some benefit during your lifetime or for a specific period of time, and then the remainder of it goes to the charity. $50,000 one time. Donor advised funds still don't qualify. These are the requirements for these split interests to be counted. Their contribution must be otherwise deductible as a charitable contribution under the IRS code, section 170. Any income interest in the split interest entity must be only for the IRA owner and his or her spouse. So you can't name the income interest to be anybody else. The income interest cannot be assigned. Yes, that would be after death. That's how I'm reading that. Distributions from the split interest entity must be treated as ordinary income to the IRA owner or spouse, reflecting no return of principal, and the split interest entity must be funded exclusively by the QCD. If it is funded by other sources, it cannot be used for QCD. So you can't blend these things together. So I understand that's a little complex. If you have specific questions, I'm not going to go through this example. I actually omitted several examples because it's just too much. But if you have specific questions about, hey, I'm interested in this. I've been thinking about a charitable remainder trust or a charitable remainder muni trust or a charitable gift annuity, and I'd like to plan for that one-time distribution from my IRA to one of these trusts or annuity. Or if I'm now over 70 and a half and I'd like to do that, then you can reach out directly. You can always reach us at questions@attleborowealth.com, or that's questions@attleborowealth.com, and schedule time for us to talk. Okay, let's see. All right. So again, I'm not going to go over this. We just talked about it, but with the split interest, $50,000 per IRA owner, one time. Yeah, that's okay. Oh, here's a good point. So here's an unknown. I like that Ed and his team do this because they basically say, watch out for this because the changes don't address this, but this is something that we're keeping an eye on. So here's the unknown. Secure 2.0 allows individuals to make a one-time $50,000 QCD qualified charitable distribution through charitable gift annuities, charitable remainder unit trusts, and charitable remainder annuity trusts. So that's what I just said. That's why I'm kind of going quickly. It's not clear, however, whether the $50,000 one-time distribution is subject to the overall annual $100,000, even if it's increased, QCD limit, because QCDs of up to $100,000 annually, and the one-time allowance of $50,000 to a split entity. are in separate sections of the tax code. That's what the because. All right. So the allowances are in separate sections of the tax code. So what they're positing here is, okay, could you really do $150,000 in 1 year? That's a question. It's not, I'm not giving you a thought on it. That is unknown at this point. So we're going to be looking for some clarity on that. So this is actually a really good taste. And, I'm giving credit to Edna's group here. So this is from 2023. As I told you, just April, as recent as April 26th through 28th. So this is kind of still hot off the presses. But I give credit. This is not my material. It's just, material I have access to on a regular basis. And I'm very appreciative of that. So I want to give credit where credit's due. All this information comes from the manual. So this section here is, I wrote myself a note. This is from October 2022. And this is really important, folks. So it's good to know about the expansion. We can put more than $100,000 in starting next year. It's good to know about split interest. That may or may not be a thing for you. But if you're considering qualified charitable distributions at all, these things I'm about to talk about, you must know about, or it could easily be disallowed. This significant advantage you have, again, if your plan works out where it makes sense for you to take money out of your IRA and gift it directly to a charity, you're not going to use it over your lifetime. Then you've got to follow the rules on this, and you can't be complacent about it. You can't mess around, because it can really sting you if the IRS comes back and says you did it wrong. And folks, I'm just going to pull up this manual again, because a good section of this, I don't know how many pages, but a good section of this manual every year is case law and tax court cases. So people make mistakes about things all the time, and they think they understand the rules, and they've got it wrong. They get bad advice. So QCDs are going to start making up more and more of these cases, these tax court cases gone wrong for the taxpayer. So let's look at some of the substantiation and benefit back rules. So first is, I'm just making sure I'm not cutting myself off here. Again, you can, if you're a detail-oriented person, I'm going to give you some IRS codes and IRS notices that you can look up yourself. Substantiation rules for charitable itemized deductions apply to qualified charitable distributions. So if you can't qualify the charity normally as you would through your itemized deductions, you cannot qualify it through a qualified charitable distribution. So they're two different things. One of the strong benefits of the qualified charitable distribution is it goes right to the charity. It doesn't actually even hit your tax return, so you don't have to itemize. Most retirees don't itemize. They're getting their standard deduction, so you don't have to itemize. You don't have to follow the adjusted gross income limitations and all that. It goes right through. It distributes. There's no tax. It's easy. But it still has to follow the same rules that would allow for an itemized charitable contribution. Hope that makes sense, right? Not the AGI rules, but the rules around it being a legitimate charity and how you document it. Hope that makes sense. AGI is adjusted gross income. But so QCDs you don't have to worry about, I know it gets confusing. You don't have to worry about adjusted gross income with qualified charitable distributions, but you have to meet the same requirements to make it a real charity and to document it. Okay, so let's give here. So for substantiation rules for cash gifts to charity. So gifts under $250, a canceled check is fine, or other receipt, that's okay. No aggregation required, meaning that each gift is separate contribution. If you give, say, $20 per week, these gifts are not combined. Cash gifts of $250 or more, there's a required item, and it's a contemporaneous written acknowledgement. So hopefully you're getting these directly from the charity, and then you're keeping those in your tax record. So that's a CWA. Here's another set of initials. So we have RMD, we have QCD, we have AGI, we have, I shouldn't even include AGI because it's not part of QCDs, but so we have RMDs, QCDs, now we have CWAs. So a CWA is contemporaneous acknowledgement. You can think of a CWA as a CYA, and I think everybody knows what that means. I'm not going to say it here, but that's from the charity. There is no aggregation, so each contribution must have a separate written acknowledgement. I'm going to read a lot of this because it's important. The CWA must include the amount contributed and whether the charity gave back any goods or services other than token, insubstantial, or religious items. But we're going to talk about this. I don't mean to underline any of it. I don't mean to underline the religious part, including a good faith estimate of these goods and services. So the CWA must include the amount contributed and whether the charity gave back any goods or services, including a good faith estimate of those goods or services. All right. What does contemporaneous mean? It means that the written acknowledgement from the charity must be in hand by the earlier of the date the tax return is filed or the due date of the tax return, including extensions. So it's not something you can go back and get if your filings are late, right? QCD qualifications: donation must be 100% deductible. To qualify as a QCD, the contribution would have to be 100% deductible as a charitable contribution, is what I was talking about earlier, for itemized deduction purposes if it were made outside of the IRA. So again, it doesn't follow these same adjusted gross income guidelines, but it has to meet the same parameters, right? The same requirements if you were doing it outside the IRA. And that sentence explains that. However, the 7.5% adjusted gross income limitation does not apply, and the QCD amount does not affect any other AGI limitation. Doesn't even hit your tax return. And again, here's the code section if you're into that kind of thing of the IRS code. Split interest gifts. So we talked about these won't qualify as QCDs because they're not. Oh, excuse me. So that was, remember, this was 22. So this is important. So that's no longer the case. Now it's up to $50,000, one time each. So this is a really good example of why it's important to stay on top of things. If somebody was relying on an old manual, this is from October, so it's not that old. But you'll see that split interest gifts aren't allowed as of October, but they're allowed as of February of this year. So that's good. Donors must have a CWA from the charity, and there can be nothing received in return except those goods or services the IRS allows to be disregarded. So we'll look at that below. Otherwise, a QCD is disqualified. The funds transferred from the IRA to the charity will be included in income. That's scary. Think about it. The way this happens is, I'm sorry, I'm backing away from the microphone. I don't know if you can hear me, but the way this happens is it's not like you do your QCD, you're older than 70 and a half, you do your QCD, you file your tax returns, you have a distribution that comes out of your tax return. Or excuse me, distribution comes out of your IRA that's not reported on your tax return. So it's a tax-free distribution, but you fail to get a proper CWA. So it's at the IRS, typically isn't notified or isn't going to discover this right away. It may be something that you discover, or you have, a general audit or something like that. And this might go on for years. Now think about if you're doing $100,000 a year or $50,000 a year, or for crying out loud, just $10,000 a year. And it goes on for 5 years, for example. And now you've got to take all that money back as income. That stinks. And you won't get the money back. You have to report it as income because you've already given it to the charity. You'd have to write to the charity. I don't even know how that would work. You'd have to write to the charity and see if they'll return it, but I don't think that would be the case. So then you end up paying tax on something you don't even have. So it's important to do it the right way. This is a good point. Disqualified QCDs may also qualify for an itemized deduction if itemizing, but again, most people don't. So just avoid it. Just do it the right way. What about small token gifts? Small token items is a gray area, but there is some IRS guidance. The best practice is not to receive anything in return to make sure the QCD will qualify. This all comes down to the charity's own interpretation of these rules and what they show on the written acknowledgement letter they provide. If the charity shows that no goods or services were provided to the contributor, that should be sufficient. Folks, if you're on a board, charitable organization, make sure your CWAs are appropriate. You'd be doing your folks a favor, right? Your contributors. So disregarded gifts back to the donor. This is an example, and here's the IRS publication. Under the tax code and regulations, goods or services of insubstantial value can be disregarded, including intangible religious benefits. Certain memberships can be disregarded. Any rights or privileges that you can use frequently while you are a member, such as free or discounted admissions to the organization's facilities or events, free or discounted parking, preferred access to goods or services, and discounts on the purchase of goods and services. But item 1 doesn't include rights to purchase tickets for seatings at an athletic event in an athletic stadium of a college or university as a result of the contribution to such institution. Listen, folks, again, it limits the value at $11.30. Just don't take anything is my advice. If you're using QCDs as a planning technique, and it can be very powerful, just don't take anything. It's just not worth it, because you'll see here that I'm just seeing there's a section here that talks about it being disallowed. So let's see if we can find that. Oh yeah. Okay. What happens? Let's talk about this. We talked about the charity issuing the CWA. Okay, that should be that. I think we've covered that. What happens to the QCD if there are benefits, goods, or services given back to the donor? The QCD fails if anything with a value beyond the membership benefits or token item exceptions is received back. For QCDs, though, if it turns out something of value was received, the tax penalty is greater than with an itemized deduction. With an itemized deduction, if you give $10,000 but receive value in return of $500 in gifts, dinners, etc., then you still receive a net deduction of $9,500. So if you were doing a normal itemized deduction of your charitable contributions and you in an audit, it was discovered that you received $500 back, they could make an adjustment and say, well, listen, you're only getting the deduction of $9,500. However, if you do the same thing with a QCD, the entire QCD fails. So they don't adjust it by $500. They say it didn't work. You did it wrong. Now you have to realize the entire contribution is income. So I think about that, or entire distribution as income. Let's say you do the maximum amount, $100,000. You sent it directed to charity. You did everything you're supposed to do. Even if the charity writes you a letter, but you get a value of $500, and it's determined that you get a value of $500. The IRS in this audit sees that value, and it actually should be listed in the letter, right? Because it'll tell you the value of the contribution. The entire $100,000 comes back to you as income. So again, you may not probably won't get the $100,000 back from the charity, but you're going to have to pay tax on that $100,000. So do it right. This is why it's best not to receive anything back, so there will be no issue. I'm here. This is why it is best not to receive anything back, so there will never be an issue. All right, so here's some additional guidelines. I'm just going to leave them here for a minute if you want to pay attention to the sections. So IRS Regulation Section 1.170, A 1 through 13, subsection F, 8, I, and B. So you can search those all yourself, but I'll leave those there for a second. And then there are more. We talked about IRS Publication 526, excuse me. So IRS Publication 526 refers to charitable contributions, and you can read through all of that if you'd like. And these are just some more details and repeating. And these are directly from the publication. And that should be our last page. So I hope that that was helpful regarding QCDs. I also hope that you got to see, I'm trying to go back to the beginning. I just want to share with you, look at all these pages that we just went over. So really, I hope that this has been good information for you. I'm trying to get back to the top there. There you go. So we talked about qualified charitable distributions and how they line up with your required minimum distributions. That was the purpose, but not really anymore, because you can start a QCD, qualified charitable distribution, at 70.5. You don't have to start your RMDs today until age 73, but it's okay. It should be part of your planning if it makes sense for you, but only if it makes sense for you. Make sure it fits in your plan. You don't want to send funds to a charity that you may have to use during your lifetime. And there's only one way to determine whether you're going to need that money, and that is through proper, thorough, and comprehensive financial planning. So make sure it fits in your plan. The QCD allows charitable contributions up to $100,000 per individual. This will start increasing for inflation next year. Must be issued direct to the qualified charity from the IRA. Must be done after the donor passes 70.5. Not in the year you turn 70.5, but you must pass that half birthday at 70.5. And we went over a lot of substantiation rules for charitable itemized deductions and how they apply to the QCD and the documentation that's required. So I hope that was all helpful. We do have a question. So Doug asked, can I write checks personally directly from an IRA account to a charity as a QCD? I guess if you have the ability to write an IRA, a check directly from your IRA, I guess you probably could. I don't think I would do it that way. I would make sure, I think I would have the custodian, right? So we custody with Charles Schwab, but a custodian could be Fidelity, Vanguard, whomever. I would do a request, whatever written request there is for the custodian. It wouldn't even, I'm trying to think of what it would be. I don't handle that side of things, but it would either be a third-party check request or a combination of third-party check request and an IRA distribution form here, with us. But whatever your custodian requires, I would submit it through them in their proper documentation and have them issue it directly to the charity for record keeping. I wouldn't mess around with issuing it yourself. And Jerry just clarified my question pertained to a non-spouse beneficiary. So let me address that offline, Jerry. If you want to send me that question, I'm happy to do that. We're coming up to 10:53. I appreciate you all being here. I hope that was helpful. If you have any questions, you can send questions into questions@attleboroughwealth.com. That's questions@attleboroughwealth.com. If you want to schedule time to see me, you can also find a time by emailing us at questions@attleboroughwealth.com. If you haven't already, hit the subscribe, like, and notification button on YouTube. And otherwise, I hope this was helpful, and I'll see you all next week. Take care.